Hey team, Ben from Pivot Wealth here, and today I'm bringing you the money news in human words, helping you understand the key things that you need to know to make sense of the headlines and figure out what makes smart moves for you. Look, the first big piece of news that we've got for this week is the New South Wales government coming out talking about potentially abolishing stamp duty. More of this is due to come out in the 21 June New South Wales state budget, but potentially a huge thing for property investors, property owners. What they're talking about, and I was just looking at an example where on a $650,000 block of land, the stamp duty would generally be $24,000. The annual tax under the proposed scheme was only $1,300 a year. So a significant saving, and one that for property buyers, it avoids the need to save a really big part of the deposit. Stamp duty generally runs at about 4% of the property value. So if you're buying, $1 million property or thereabouts, or even the $500,000, doesn't really matter what the number is, but on $1 million property, that's $40,000. On a $500,000 property, you're talking about $20,000, and not needing to save that amount of money potentially means that you're getting into the property market much sooner, which is really helpful because a lot of investors have been caught in this trap where they're essentially chasing their tail, looking at the property markets rising, and really they see the value keep going up, can't save up the deposit, and they're sort of caught in this spiral. So could potentially help a lot of people get into the property market sooner. It is important to note, and I just put some content out about this and got a lot of people talking about the fact that the government is going to end up better off, which they probably are with this land tax. When you factor it in over a period of time, it's somewhere between like 12 and 18 years is the break-even point. And if you hold property for longer than that, it means that you're paying more under a land tax, which is what they've proposed to change the stamp duty to. So instead of paying stamp duty, you pay this regular tax every year. And you will pay more for long-term property holders. But the fact that you can get into the market sooner, potentially a huge advantage. Another thing that's important to call out with this land tax, when you pay stamp duty, it's based on the value of the property at the time that you purchase the property. So if your property is $1 million today, the stamp duty is $40,000 today. But over time, we see property values continue to increase. And if you're paying a land tax, which is based on the value of the property in any given year, it means that in 10 years' time, when that property doubles and the land doubles, that means that you're potentially paying double the amount of tax. So I think that this is a really important strategic opportunity for investors. For some people, it's a really simple yes or no, that whether it's better or worse. But for others, requires some good spreadsheeting, which I'm pretty excited to get into to see what really makes the difference. Potentially getting more property for your money, potentially paying a bit more over time, but running your numbers there. And I think it's great to see what right or wrong in terms of the initiative. Great to see some politicians actually trying to force some actual change and reform to what's going on. So the devil will be in the details, no doubt, but I look forward to seeing that come out on the 21st of June. We'll keep you guys across what's going on in this space as well. Another thing that's been in the news last week, and a question I've been getting from investors, is around with the Australian dollar tanking versus the US dollar, and wondering whether now is a good time to be buying US shares or whether they'd be better off to wait. So the Aussie dollar is currently buying you just under 70 US cents. So it's come down quite a lot from the lows, but at the same time, the US share market has come down considerably as well. The NASDAQ, tech-heavy NASDAQ index down 30%. The S&P 500 just a little bit less than that, but still significantly down. So people are seeing a lot of buying opportunities. But with the dollar depressed, it means that you're getting a little bit less in US shares for your money. Now, I was looking at some of the data and forecasts on the Aussie dollar, and worth noting, a couple of the things that have been dragging on the Aussie dollar relative to the US in recent times has been the China lockdown. So the China lockdown, given that China is a huge buyer of Australian exported goods, the fact that the demand for those goods has been much lower with big parts of the country in lockdown has meant the dollar has weakened. Also, with ultra low interest rates in Australia, it's meant that foreign investors are less likely to buy up our interest-bearing assets. Now, both of those things are changing. The lockdowns are easing in China. The interest rates are increasing in Australia. And so the experts have forecast the Aussie dollar to be up closer to 75 to 76 US cents by September, which is a pretty big jump. And it means that you're essentially buying, a bit over 5% more shares for your money if you are looking at it from an investor's point of view. So double-edged sword. We don't know where the markets are going exactly, although with what we're seeing over the last little bit, it's probably likely that they're going to go sideways or potentially even down a bit. But for investors, being poised to pull the trigger on this stuff means you're potentially picking up on some of these opportunities and coming out of this period of volatility stronger than you went in. Another big piece of news that I was super interested in looking at last week was around Apple launching its own buy now, pay later service, Apple Pay Later, where essentially it uses the Apple Pay functionality to break up payments for stuff into 4 easy installments. The fact that Apple has a huge number of users already using the Apple Pay services means that it's got a real captive audience. I know Apple and I love Apple. I use all Apple stuff, that they make stuff super, super easy. So it means that it's likely that user experience is going to be really solid, and it seems that likely that they'll pick up some good business off the back. As a result, we saw the other buy now, pay later shares really struggling back end of last week in Australia. Zip dropped 6% after the announcement. Sezzle as well, and dragging the sector down, which sort of highlights the fact that the bigger players, or the second tier players in this space, really struggle when there is that uncertainty that's there. So I think an interesting one to watch. Makes me want to buy some Apple shares because these guys are just onto it, and I think that they'll likely get some good traction with this service. One to watch moving forward. Another one, in a slight change of pace last week, I read a great piece on 5 areas to focus on to maximize your superannuation benefits. I think in periods of market uncertainty like what we're seeing at the moment, really important to be taking full advantage of the rules and the things that you can do to get more out of what you've got. So the 5 areas, the first one was using catch-up super contributions. This is where each year, or like at the moment in the current financial year, you can contribute up to $27,500 into your super fund and claim a tax deduction for that money. Important to note that $27,500 includes any contributions that are made on your behalf by your employer. So that compulsory 10% of your salary that goes into superannuation, that all counts towards a $27,000 limit. But this catch-up contribution, what it's about is that if you haven't used up the full limit in previous financial years, you can actually catch up on those contributions. So this kicked off in FY19, so 2018, 2019 financial year. So basically any unused portion of your cap over those financial years means that you can catch up on that in the current financial year, potentially contributing tens of thousands of dollars to your super and claiming a tax deduction. So it gets the money into super where it's concessionally taxed, and that's obviously great, but it gives you some really solid tax relief in the current financial year to reduce your tax bill or pump your tax return. So I think that's a really good hack. The rules are a little complex, so make sure that you get some good advice if you're going to go down that path, but one to potentially save you some serious tax dollars. Another one was on the spouse contribution, and this one's often overlooked by people. Basically, if you have one person in a couple that's earning less than $40,000 per year, if the other person makes a contribution into their super fund of up to $3,000, they can get a tax benefit in their tax refund of up to $540. Now, I know that, it's not like tens of thousands of dollars or anything like that, but that $540 number reflects a return of 17%, which is better than any investment that you're getting. Certainly with what we've been seeing in the current period of market disruption, it's a solid return. And if you can take 17% guaranteed, that's a good bet any day of the week. So one to look into. And the third piece was around the government co-contribution. So basically, if you contribute money, voluntary contributions into your own super fund, and you earn less than $56,000, the government will match your contributions, or partly match, basically 50 cents for each dollar you contribute, up to a $500 limit. Again, another $500 in your super fund. And then two sort of more functional things when it comes to super. The first is that the income limit for super contributions is due to be scrapped. So previously, you're required to earn at least $450 per month from an employer for them to have to make super contributions on your behalf. This massively disadvantaged people that were only working a very small amount, or people that were working with multiple different employers and getting paid small amounts from a whole bunch of different employers, not receiving any super contributions. So if that was you and you're in that boat, good reminder to, at this time of year, make sure that your employer has your super details, so that when the rules change on 1 July, that they'll be able to pay the super straight into your fund, making sure that you're getting your money to where you want it to be. And then the last one was about contributing, the super contributions increasing to 10.5% from the 1st of July. So the compulsory super contributions that are mandated from employers are due to increase to 10.5% in July. They're eventually on the way up to 12%. But the next increment is coming. Worth looking at your employment contract to see if your superannuation, if your salary package is inclusive or exclusive of super. If the total amount, if it says that your pay is $100,000 inclusive of super, it could mean, well, it will mean that you'll be getting a few dollars less in your pay packet that hits your bank account, because more of the amount is going into super. If you've got a salary that's exclusive of super, means that you'd be getting a little bit more in your super fund. So look into the detail. But yeah, 0.5% pay rise for a lot of people coming essentially through their super, which is great to see. The next piece that I was looking at was around the property market again, and it was written by this journo that bought this property in Bondi 25 years ago for $164,000. The property just sold, not by the journo. They'd since sold the property, but it just sold for $1.2 million, which reflects an increase of 7 times in 25 years. So the article was talking quite a lot about the fact that things like CPI or inflation, CPI, the consumer price index, or the inflation measures, aren't really reflective of the massive increases that we've seen in the capital values of properties. And they're not captured in these things. They're certainly not captured in wage growth. And when we're seeing wage growth not quite keeping up with inflation, excluding things like the growth in the property market, then when you start to factor them in, it means that affordability becomes much lower. So there's a whole bunch of social commentary, I think, that sits around this one. But to me, the big lesson is that with property continuing to go up at this sort of rate, and while I don't have a crystal ball, in my view, that seems likely to continue somewhere close to what it's been doing over the historical past. Just means get into the property market, figure out a way to make it happen. I get that it's hard. I get that it's challenging. I get that you need to put in some work to make it happen. And sometimes it seems like it's impossible. And for some people, sometimes it is impossible to make progress towards that. But the sooner you can get in, the sooner you're in. And that is what's going to benefit you over time. So it means that for younger people, I see a lot of people, it's too much, it's too hard. They end up putting it in the too hard basket. If you want to be financially successful, you need to find a way to make it happen in some form, or at least have a clear path to get there. The sooner you can do it, the sooner you start building that momentum and getting the benefit from the growth that we're seeing. Again, the next piece is on a slightly negative note, which is around this huge, massively sophisticated scam that targeted people in Australia, and people lost millions of dollars from this company. They were basically, it was a fairly elaborate scheme where they had investors thinking that they were buying bonds and term deposits. The scammers used these legitimate business numbers that were confirmed with ASIC. They had receptionists, phone lines, website portals, and even paid back some income to maintain the lie, basically, for investors. One of the victims was even an accountant with a finance background. So it really can go to really impact anybody. And basically the recent stats from the ACCC, the Australian Competition and Consumer Commission, reports that in 2022, investors, Aussies, have lost over $157 million to investment scams. So I wanted to call this one out and say this stuff is increasing. They're getting more and more sophisticated. It's worth being super careful and doing a cybersecurity check on yourself so that you don't get caught in one of these traps and end up suffering as a result. My last piece for this week is around the New South Wales public sector workers to strike despite a 3% pay rise offer. Basically, the New South Wales public servants feeling like they're not getting a fair deal off the back of Premier Dominic Perrottet giving a 3% pay rise with 0.5% likely next year. Based on the recent inflation data being at 5.1%, though, the public sector employees are not happy with this, and particularly feeling that it won't be able to keep up with the cost of living. I think that this is an interesting, I suppose, sort of litmus test for what happens across the broader market. And I think that throughout 2022, we're likely to see more of these collective bargaining agreements and industry groups that are pushing for higher pay rises. In my view, we're obviously beyond just inflation. We're seeing huge growth in property markets and investment markets, and it is harder to actually get ahead. So I think wage growth is a positive thing, but it is obviously a challenge for business, and especially in the current economic conditions that we're moving into, that businesses could potentially struggle. But look, with the high inflation numbers, and if the US trend is anything to go by, it means that where things could potentially get worse before they get better. So for workers wanting to make sure that they're able to make ends meet, I think is an important one. Guys, I hope you found that helpful. I will catch